Hello everyone, welcome to week 10 lecture videos. Our today's topic is payout policy and introduction to capital structure. We'll be covering two chapters today, chapter 16 and chapter 17. And we start with chapter 16 first, payout policy. As usual, we have a couple of learning objectives in this chapter. Corporations can return cash to their shareholders by paying a dividend or by repurchasing shares. In this chapter, we first explain how financial managers decide on the amount and form of payout, and we discuss the controversial question of how payout policy affects shareholders' value. A simple example, suppose you own stock in a corporation that has $1 per share of unneeded cash. It can hold on to the cash or it can pay an extra cash dividend of $1 per share. Now, the question is, does this decision matter? Your first instinct should be to say no. The dividend puts $1 per share in your pocket, but at the same time, each share should be worth $1 less. Your wealth should be unaffected. But corporations usually hold cash for a reason. What if that $1 per share is not redundant money? Suppose that it was set aside for capital investment. Then paying the extra dividend could mean cancellation of investment projects. The payout decision could also be an investment decision. Suppose the firm pays out $1 per cash but replaces the cash by borrowing. Then the payout decision would also be a borrowing decision. To fully understand the payout policy, we must separate payout decisions from investment and borrowing decisions. If we hold investment and borrowing fixed, changes in cash dividends must be offset by issues or retirements of shares. For example, a company might pay generous cash dividends knowing that it will have to schedule stock issues to raise cash for investment. Another company might pay no dividends but instead use cash to repurchase shares. Therefore, we will take care to analyze the trade-off between higher or lower cash dividends and the issues or repurchase of common stock. In doing so, we will discuss different payout controversies, different payout policies, and also we will see that how these payout policies can be different based on different tax systems. Corporations can pay cash to their shareholders in two ways. They can pay a dividend or they can buy back some of the outstanding shares. In recent years, dividend payments and stock repurchases have amounted to a high proportion of earnings. Although dividends remain the principal channel for returning cash to shareholders, many corporations pay no dividends at all. In the United States, the percentage of dividend-paying stocks have fell from 64% in 1980 to 52% in 2007. If you look at this figure, it shows the dividend and stock repurchases in the United States between 1980 to 2013. And we can see that before 1984, for example, during this period, the stock repurchases were fairly rare. But since then, they have become increasingly common. You can see that red portion is the stock repurchase, and it has become increasingly common during this period. In 2007, particularly, if you look at this bar, a record year for stock repurchases. In this year, 28 US companies each bought back more than 5 billion of stock. ExxonMobil bought back 31 billion. Microsoft bought back 28 billion, IBM 19 billion, and General Electric 14 billion. So you can see that nowadays the stock repurchase has become almost similarly important of the dividends for the firms. Now, a couple of dividend terms. A company's dividend is set by the board of directors. The announcement of the dividend states that the payment will be made to all stockholders who are registered on a particular date, which is known as record date. So record date is basically a particular date on which if a stockholder's name is recorded on the company's register, the shareholders will be entitled to get this year's dividend. Then a week or so later, dividend checks are mailed to stockholders. Stocks are normally bought or sold within dividend until 2 business days before the record date. Then they trade ex-dividend. Okay, so it means that if you want to be entitled to get dividend, you need to buy the stock before the ex-dividend date. An ex-dividend date is generally 2 days before the record date. So when the stock goes on ex-dividend, if you buy the shares on ex-dividend or later, you are no more entitled to get this year's dividend. So if you have to buy shares before ex-dividend date to be entitled to get this year's dividend. Okay. If you buy stock on the ex-dividend date, your purchase will not be entered on the company's books before the record date, and you will not be entitled a dividend for this particular year. For example, here you can see for Pfizer, declaration date is December 15, 2014. And after this declaration, the record date is February 6, 2015. That means a record date means your name must be recorded on the company register on this date to be entitled to get this dividend. And company goes 2 days before the record date in the ex-dividend. As you can see, that record date is February 6, 2015. So ex-dividend date is February 4, 2015. So as the stock goes ex-dividend on February 4, if you buy the shares on February 4 or later, you are no more entitled to get this year's dividend. You have to buy the shares before ex-dividend date. And payment date is March 3, 2015, the day on which the dividend will actually be paid to shareholders. Instead of paying a dividend to its stockholders, the firm can use the cash to repurchase stocks. The reacquired shares are kept in the company's treasury and may be resold if the company needs money. There are 4 main ways to repurchase stock, which you can see here. By far, the most common method is for the firm to announce that it plans to buy its stock in the open market, just like any other investor, so which is known as buy shares on the market. However, companies sometimes use a tender offer where they offer to buy back a stated number of shares at a fixed price, which is typically set about 20% above the current market price. And shareholders can then choose whether to accept this offer. So, which is a tender offer. The third procedure is known as Dutch auction, and in this case, firm states a series of prices at which it is prepared to repurchase the stock. Shareholders submit offers declaring how many shares they wish to sell at each price, and the company calculates the lowest price at which it can buy the desired number of shares. And last of all, repurchases sometimes take place by direct negotiation with the major shareholders, which is known as private negotiation or green mail. So this is the end of our discussion on payout policy and dividend terms. Please watch the next video for our subsequent discussion. Thank you.